Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 129. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be treated as investment advice. Listeners should be aware that we will be discussing securities they own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. First of all, thank you to everyone who took part in our Discord chat with Rogue Trader this last week. It was great, and we will be doing it again in September. Thanks particularly to Rogue for his hard work. Now, I'm afraid that you only have me today because Richard has succumbed to food poisoning. We were at a barbecue last night, and he made the mistake of having the chicken. I didn't. Okay, news this week. Well, China has warned its economists not to be too negative amidst fears that it is entering deflation. Now, we'll show you the Chinese inflation numbers, and they're negative year on year. So China has fallen into deflation. But warning its economists not to be too negative brings into question the trustworthiness of its data, and that's something we're going to have to bear in mind in the future. Now, the Chinese property developer Country Garden has missed $2 bond payments, and its sales have collapsed over the past year. The Chinese economy does not look to be doing very well, and the Biden administration has imposed a ban on US investment into Chinese tech starting next year. We showed you last week how FDI into China has collapsed. Now, also Moody's cut the credit ratings of 10 medium-sized US banks last week and put the ratings of 6 large banks up for review. And Moody's cited reduced profitability, declining asset quality, and unrealized loan losses. As we've discussed before, the US banking crisis is just ticking away there in the background. There are a lot of losses that need to be taken on commercial real estate, particularly offices. Italy imposed a windfall tax of 40% on its banks, which sent Italian bank shares falling, and the EU gas prices spiked this week on fears that strikes at 3 Australian LNG plants would lead to restricted supplies. Those LNG plants in Australia produce about 10% of global LNG. And finally, the big data of the week was US CPI, which came in soft at 3.2%, gets expectations of 3.3%. So up, but not as much as expected. This is the chart of US real interest rates. And as inflation has fallen and US interest rates have risen, so monetary policy in the US has become much more restrictive. The full effects of that, I think, are yet to be felt. China looks to be falling into deflation. The GDP deflator is already strongly negative, and we'll show you in a bit CPI is also negative. And the Chinese property developer Country Garden's sales have fallen 75% from 2021. So the dark blue lines are 2021 sales and the pink lines are 2023 sales. You'll see its sales have collapsed and it's got big debts. So it faces $2 billion in interest payments on its dollar bonds this year, and it's late on 2 payments. It looks to be heading towards default. Okay, and on to the economic data. Now, it was a light week this week. So we had the UN Food Index for July, and that has bounced well down from its highs, but rising again. And if you look at the components, you'll see that is due to rising sugar prices, although The other prices seem to also stabilize. The big falls year on year seem to be past. And food prices are down 11.8% year on year. Okay, this morning we had UK GDP numbers for June, and they were great. So expected at 0.2% month on month, came in at 0.5%, bouncing back from contraction in May. And that made the year on year number plus 0.9%. So the UK is avoiding recession, actually bouncing back despite high interest rates in June. And if you look at the ONS's breakdown of those GDP numbers, you'll see that actually it was manufacturing and construction were responsible for the strength of the UK economy, not services. Manufacturing had a good beat on the back of strong pharmaceuticals production. So this is industrial production rose 1.8% month on month in June. Very good. The yearly numbers were therefore positive at plus 0.7% year on year, massively beating expectations. Construction activity also rose strongly. So year on year, 4.6% against expectations of 1.9%, suggesting construction output grew strongly in June. But reminder, the HMRC payroll count in June fell by 9.3 thousand, and the May number was also revised downwards. So we're getting some slightly contradictory signals from the UK economy. Employers are cutting jobs, but the economy overall is doing well. Now, construction orders in Q2 massively missed. So they were expected to increase by 8.5%, and actually they've continued to fall, down 17.7% year on year. That is a huge miss. And so the strong construction activity in the UK is due to builders completing existing jobs. The future order book looks weak. The Royal Institute of Chartered Surveyors house price balance missed expectations, as you would expect, given very high mortgage rates, down to minus 53 against expectations of minus 50. That is the balance of chartered surveyors reporting house price falls. And July numbers, the British Retail Consortium retail sales year on year missed expectations, falling to 1.8% year on year in July, well down on June. The commentary is the weather was poor in July. Halifax house prices down 0.3% month on month in July, below expectations, and now down 2.4% year on year. But that was better than expectations. The BBA mortgage rate continues to climb. Moving on to the US, we had no EU data this week. The big number in the US was CPI, and month on month that met expectations at 0.2%, unchanged since June. Year on year, it bounced slightly, but was better than expected, coming in at 3.2% against expectations of 3.3%. Core, month on month, unchanged at 0.2%, meeting expectations. Good news, year on year, it also beat expectations, but remains far too high at 4.7%. Although, as we have discussed before, that is due in part to the lags in owner equivalent rent, which will keep CPI above its true figure for months yet. So if we step back and look at US inflation, it does look like a supply shock. We have had a one-off surge in inflation, which is now falling back. So the dark blue line is the global supply chain pressure index, and the green line is US core goods. So goods inflation in the US is certainly following the pattern you would expect from a supply chain disruption. The problem is that wage growth remains far too high, and so the Fed needs to keep interest rates high until it creates some slack in the economy to get wage growth down. We look at the components of US inflation, you'll see that shelter continues to cause CPI to be higher than it should be. And if you look at core services ex shelter, then really there's very little inflationary pressure there. Moving on to used car prices, they continued to fall in July at minus 1.6 month on month, and year on year at minus 11.6%. Consumer credit beat expectations in July at 17.9 billion, well up on June, and the June number was also revised upwards. But it's not clear whether that's good or bad. Are consumers borrowing because they're confident, or are they borrowing because they're desperate? The retail sales, Johnson Redbook retail sales rose 0.1% year on year. Reminder, that is a nominal number, so real volume sales are going to be strongly negative. And the 30-year mortgage rate ticked up again to 7.09%. Mortgage market activity faded towards its lows for this cycle, well down on activity post-pandemic. Initial jobless claims jumped a bit to 248,000, up from 227 last week, but the weekly numbers are very volatile. If we look at the non-seasonally adjusted numbers, you'll see that 2023 is running ahead of 2018, 2019, and other normal years, but is not particularly elevated yet. Continuing jobless claims fell slightly from last week, but appear the downwards drift we've been observing over the last few months appears to have ended. Turning now to China, the numbers from China are not good. So Chinese exports fell 14.5% year on year, missing expectations. Imports showed a massive miss, down 12.4% year on year. And that implies the Chinese economy is importing less goods because it's not doing very well. And CPI month on month in July was plus 0.2%, but year on year, it was minus 0.3%. China is in deflation. And I would observe this plus 0.2% number in July comes after a string of negative prints and after the Chinese Communist Party ordered its economists not to be too negative. So how much can we rely on that figure? If you look at global inflation, everywhere it's coming down. Chinese PPI also missed expectations, coming in at minus 4.4% in July year on year. So in summary, a light data week for the UK. GDP data released this morning shows the UK economy grew 0.5% month on month in June, beating expectations. Manufacturing and industrial production bounced strongly, and construction activity remains robust. However, UK house prices are falling, construction orders continue to fall, and July retail sales missed expectations at 1.8% year on year, implying that retail sales fell in July. The bottom line is the UK economy continues to show unexpected resilience despite rising interest rates, but rates are still rising and the labour market is weakening. Wage growth remains too high. We expect the Bank of England to keep rates higher for longer until it gets some slack in the labour market, and that means slowing the UK economy. In the EU, we had no data this week. In the US, well, the great news was inflation came in soft, although core CPI remains at 4.7%, still too high. Core services ex-shelter looks subdued. It looks like inflationary pressures in the US are fading. But as we will show you in a second, US wage growth, according to the Atlanta Fed, remains far too high. Consumer credit was unexpectedly strong. The bottom line is that US inflation seems to be returning to target, and the Fed is therefore unlikely to continue to raise rates. It looks like the Fed hiking cycle is over. Now, in the coming months, the US economy faces headwinds from the lagged effect of rapidly rising interest rates, a negative credit impulse, and tightening fiscal conditions due to the restart of student loan repayments. We have a section on that coming up. We expect the US economy to slow in the coming months. In China, both imports and exports missed expectations. They were negative year on year and still deteriorating. That suggests the Chinese economy is not doing well, and China has fallen into deflation. Okay, on to one chart. So this chart shows US personal consumption expenditure as a percentage of GDP, and that's the dark blue line, and domestic investment, which is the green line. So it looks like the US economy has been strong because personal consumption expenditure has been resilient and growing. But the other way to look at that is investment has been falling, and so the share of consumption in the economy has been rising, and that is a normal process around recessions. Pause, take a look. And reminder, we're expecting personal consumption to come under pressure in the coming months as US student loan repayments resume. More on that later. Okay, now on to US inflation base effects. And last week I showed you this chart, which purports to show that if US inflation stops falling, then because of base effects, CPI will tend to head back up. And this is from the Bank of America, and it shows that if CPI continues at 0.2% month on month, and that's the last couple of months have had that, then they expect US CPI to bounce to 3.9% by the end of the year. Reminder, it's currently 3.2% in July. However, the FT have looked at that Bank of America chart and they don't like it because the Bank of America chart uses non-seasonally adjusted data. If you use the more conventional seasonally adjusted data, you get much less scary results. If inflation continues at a monthly rate of 0.2%, then inflation will continue to fall according to their calculations. So bottom line, it doesn't look like base effects for US inflation are anything to be scared of. And on to inflation watch. So the numbers coming out of the US this week were that CPI inflation rose slightly to 3.2%, but core fell to 4.7%, still too high. There was no other data. So this is a breakdown of wage growth by industry in the US, and you'll see that it marks some big divergences with leisure and hospitality at the top, and wage growth is still too high at 4.4%. And I found this astonishing. So this is from UPS, and their CEO stated this week that the average UPS driver is now on $170,000 per annum in pay and benefits. But after discussing this with a US fund manager yesterday, it appears this just applies to long distance truck drivers and not to the delivery men you're used to seeing. But still, those are big numbers and shows just how tight the labor market has been. And according to the Atlanta Fed wage tracker, wages actually ticked up in July to 5.7% per annum. Way too high for the Fed to feel comfortable. Now, the official numbers are lower than that, at about 4.4%, I believe. And finally, in the UK, this is from Unilever's annual results, and thank you to Discord member Richard Wilk for sending this. And this is the price growth they are seeing in their different product lines. And you'll see that inflation has come down, but it remains very elevated. And you'll notice that ice cream inflation, i.e. food inflation, remains very high. So in summary, US inflation came in soft, but wage inflation remains too high. Expect the Fed to pause, but there's no reason for it to cut rates until wage inflation starts to fall. On to recession watch. And this is the global manufacturing index. And it is falling again. It's in negative territory and falling further. And global container shipments are right back to pre-pandemic levels, although they seem to have stopped falling. So you can see goods inflation in one chart here. Massive demand met restricted supply, leading to huge goods inflation, but that is fully unwound. Now, wholesalers' inventories to sales ratios in the US picked up in June to highs not seen since the pandemic or the GFC, and that suggests that wholesalers will not be ordering from manufacturers anytime soon. We talked about this last week, but the number of US multiple job holders has risen back to its 2019 levels. So evidence that poorer workers in the US have got through all their pandemic savings and are now having to go back to do multiple jobs to make ends meet. And CFOs in the US are not confident. They're not taking on risks, i.e., they would be wary of making investments. And this is really interesting. And thank you to Discord member Jaw It for sending this. This is the LinkedIn hiring rate. And you'll see falling further in July and well below 1. So further evidence that the US jobs market is slowing and people are less confident about finding a job as a result. Now, unemployment in the US is rising, and what's interesting is that it seems to be rising hardest amongst the highest paid workers. That is the light grey line. Lower paid workers, unemployment rising much less quickly, and household borrowing costs rising rapidly, as you'd expect from rising interest rates. And in the case of credit cards, we also know the default rate is rising. So credit card providers are having to compensate themselves for the increased default rate and their increased funding costs, leading to much higher rates for consumers. And as a result of all that, personal interest payments have risen sharply in the last 18 months. Leverage loan yields have also risen very sharply, up from below 4% 2 years ago to 9.6% now. And Moody's are forecasting that this will lead to around half of high yield borrowers with a B3 rating being unable to service their debts by the end of the year if US interest rates remain high, and I fully expect they will. Now, B3 is about halfway down non-investment grade, i.e. high yield grade. So investors in high yield bonds are going to have to expect some losses later in the year. And we know high yield bond spreads are currently quite low, which seems delusional. There are losses coming. So the light green line is the high yield spread. And despite Moody's warning about higher coming defaults, it remains subdued. And this chart shows that there historically has been a strong correlation between bank tightening and the high yield loan spread. And that is very wide at the moment. Are markets too complacent? And finally, US home buyers are taking on record amounts of leverage in order to buy new homes. So this is the debt to income ratio, which is close to 40%, even as interest rates and mortgage rates have risen strongly over the last 18 months. Is that sustainable? So in summary, a default cycle has started for heavily indebted US corporates, but the high yield bond spreads remains low. Investors seem complacent. The labor market is definitely slowing, as evidenced by last week's non-farm payrolls and this week's LinkedIn data. Consumers are borrowing more and more and paying much more in interest. Is that a sign of consumer weakness or strength? We ask ourselves. And on to soft landing watch. Well, the regional bank ETF in the US has bounced over the last few months. And we know deposits have flowed back into small regional banks. Confidence there seems to be returning, although we know that there are a lot of losses on commercial real estate that will need to be taken in the coming months. Now, 314 Research are saying that the fiscal spending should be enough to ensure a soft landing. So the red line in the bottom chart is the deficit. The green line is loan growth. And so what they're saying is rising fiscal spending should offset the negative credit impulse. But starting in October, the fiscal impulse should turn negative as lots of US students start repaying their debts. More on that later. So last week we talked about the non-farm payrolls, which were weak, but actually most industries continue to add jobs and the diffusion index continues to look okay. A worry for the US is that the deficit just seems completely out of line with unemployment. Normally, you see the two are highly correlated. And so deficits rise during a recession to stimulate the economy. And then during the good times, the deficit falls and the government builds up financial resources to be able to spend again in the next cycle. Well, this time, unemployment is very low, actually at a record low, and the deficit is very high. Now, we know that part of that is due to much higher interest costs, but excluding that, we calculated a few weeks ago that the government is running a primary deficit of 2.9%, very high for an economy that is doing okay. What will happen when the economy slows? And reminder, the Fed is aiming to slow the economy. I found this amazing. So this is US heavy truck sales, and they have surged to an all-time high on a seasonally adjusted basis. And we know that logistics firms in the US are suffering, and some of them have recently gone bust as the amount of goods going around the country have declined. So that suggests that these are late deliveries of previous orders. Taiwanese exports, which are a good bellwether of the global economy and global trade, well, they bounced strongly in July. So, is that a sign of a recovery? We talked months ago about how US multifamily construction was at an all-time high, and it's continuing to rise. Now, at some stage, you'd expect the fall in new orders to lead to that peaking and a lot of new apartments coming onto the market, but that hasn't happened yet. And we are in the second half of the year. Finally, the Atlanta Fed GDP now real-time estimate for Q3 in the US continues to rise and is now at 4.1%, suggesting the US economy is strengthening and doing very well. And if you break down the contributions to that GDP forecast, you'll see that government spending is still positive, that consumer spending remains strong, but above all, companies are rebuilding their inventories. Now, that's odd, given that we know that inventories to sales for householders is very elevated. How long can that continue? So the bottom line for a soft landing watch is that currently the US economy is doing just fine, and it has defied rapidly rising interest rates. Can it continue to do so? Well, on to US student loan repayments. So the big question is, how will the restart of US student loan repayments affect the economy? Now, reminder, interest on student debts in the US will start accruing from the 1st of September, and payment demands will arrive in October. Now, the Biden administration has proposed a new income-based payment plan that will reduce monthly payments in the near term, but extend the life of the loans. And it's unclear what the take-up of those new Biden-Harris loan repayment terms will be, as students will end up paying more over the lifetime of the loan. And student loans are enormous. There are 1.8 trillion of them outstanding. Pause, take a look. So this is the timeline of the forbearance scheme, and no interest has been paid on loans since March 2020, with the result that students under 25 have never yet had to pay for the student loans. This shows a breakdown by age of student loans and the amount outstanding. So 62% of student loans are to people under 40, and their average balance is 32K. And the average amount people with a student loan will have to pay is around $3,600 per annum. Now, we know that the average wage in the US is around $76,000, so that is a substantial 5% of gross income. So depending on the take-up of the new Biden-Harris income-based repayment plan, the estimated annual payments are expected to be between 157 billion and 97 billion, which would reduce retail sales by between 0.6 and 1%. So not a huge reduction in retail sales. In 2019, repayments were 91 billion, and since then, we've had 3 million more borrowers and an extra 200 billion in borrowing. So that fall in retail sales of between 0.6 and 1% appears manageable, but What matters is the fall in discretionary expenditure, not overall retail spending. And so this table shows the average income by age cohort and their spending by category. So under 30s have an average income of $65,500 and they spend a total of $53,000 per annum after tax, and 19,000 of that is on housing, 3,700 is on food, 9,008 transportation, leaving them 17,800 of discretionary expenditure. Now, under the standard repayment plan, they will have to pay $2,386 per annum on average, which would reduce their income by 3.6%, but it would reduce their discretionary expenditure by 13.4%. If they go for the new Biden-Harris income-based repayment plan, their payments will fall, but discretionary expenditure would still fall by 9.2%. Pause, take a look. The bottom line is the restart of US student loan repayments will reduce discretionary expenditure by between 9% and 15%. And that can be expected to have a big effect on the leisure, restaurants, and durable goods, consumer durable goods sectors. US consumers have also added to their debts over the past 3 years. So rising interest rates will also be squeezing their discretionary expenditure. The main effects on the under 30s will be to stop them becoming parents and starting a family and reducing their desire to buy new vehicles. And we showed you this earlier. So far, strong consumer spending in the US has kept the US economy resilient. If consumer spending now falls, then we expect the US economy to slow. Bottom line, the resumption of student loan repayments in the US amounts to fiscal tightening and will reduce US consumer discretionary spending by between 9 and 15%. Now, last week on the Discord, we were talking about the outlook for oil prices, and we're talking about peak oil. And I mentioned that the world will never run out of hydrocarbons because there are vast quantities of them. In particular, there are vast quantities of untapped methyl hydrates. Now, what are methyl hydrates? Well, methyl hydrates are solids, they're white, ice-like solids of a matrix of methane and water that form on the seabed under conditions of low temperature and high pressure. And this is a picture on the left here of a methyl hydrate. So the way they're formed is that when organic matter, and particularly plankton, fall onto the seabed, that then decomposes, releasing methane. And at the bottom of the seabed, it's very cold and under enormous pressure, and these methyl hydrates form. Now, they tend to form around the continental margins, not in shallow waters where it's too warm, and not in deep waters where there's not enough organic matter to decompose and produce sufficient quantities of methane. But they're there in absolutely enormous size. So this is the amount of carbon locked in different forms of hydrocarbons. So the biggest hydrocarbon source we have currently is coal. Oil is much smaller, gas smaller still. The amount of methyl hydrates trapped on the ocean floor are estimated to be around 5 times greater than all the known coal deposits. And I've previously read that if we were to burn all the methyl hydrates trapped on the ocean floor, we would use up all the oxygen in the atmosphere. This is an absolutely vast resource. And this is a picture of methyl hydrates burning. Methyl hydrates can be mined to create methane gas. And better than that, German scientists have shown that you can pump liquid CO2 down onto the ocean bed, and there you can substitute the methane in the methyl hydrates for CO2. So you get these CO2 hydrate complexes, which are actually more thermally stable. And that is a win-win situation. It would mean storing carbon and getting usable gas. And in 2008, Japanese scientists successfully liberated methane gas from methyl hydrates on the ocean floor by warming the seabed. So we can harvest methane from the seabed if we desire. And I found this is a proposition for how to do that. So what they're proposing is you drill down into the methyl hydrate deposits on the seabed, and then you pump up the mixture of mud and methyl hydrates. And as that rises, so you pump in gas, and that causes the buoyancy of that mud mixture to rise as it rises towards the surface. So the pressure reduces, and so the methyl hydrates break down, liberating methane, making the mixture even more buoyant, which sucks up more mud and methyl hydrate from the seabed. So it's technically feasible. However, the risk is that as global warming increases, so temperatures rise and those methyl hydrates start to break down and produce methane, which is 28 times more warming than CO2. So you then get this terrible feedback loop where warming releases more methane, which creates more warming. Now, most methyl hydrates are trapped in very deep waters, and frankly, climate change is not going to affect them at all. But around 5% of methyl hydrates are in shallower water or the permafrost, and that has been observed. In 2008, British and German scientists saw gas seeps off Spitsbergen, which were probably caused by the breakdown of methyl hydrates. So, bottom line is, we will never run out of hydrocarbons if we choose to start exploiting methyl hydrates. It's all a question of cost and our desire to keep on burning fossil fuels. And onto other charts. Well, we saw the UN Food and Agricultural Organization's food index this month ticked up slightly. Well, climate change is disrupting global food supplies. This is Thai rice prices, and they surged after Thailand urged its farmers to curb plantings to save water. And these are olive oil prices. And we've had a drought in Southern Europe, sending olive oil prices through the roof. Expect climate change to lead to more disruptions to food supply. And this week, the Bank of England chief economist, Hugh Pill, was warning that UK food inflation was likely to remain at 10% by year end. Still very high. Okay, and after all that, you need some good news. Well, this is great news. We have massively overestimated the amount of plastic in our oceans. So previously, the amount of plastic in the oceans was calculated by taking all of that plastic produced, subtracting recycling, landfill, and burning, and assuming that the unexplained remainder all ended up in the ocean. Well, Dutch scientists have actually done some sampling of the oceans, and they've shown that that is just not true. So previous estimates had been that the oceans contained between 50 million and 300 million tons of plastic. They calculate the actual number is somewhere around 3.2 million tons. So a small fraction of what was previously estimated. And that is great news, although still too high. And onto equities. Well, the FTSE All-World Equity Index had an indifferent week, down 0.2%, up 13% year to date. All these numbers are from before the market opened today. The all share had a decent enough week, up 0.7%, but up a paltry 2% year to date. The Euro Stoxx 600 was up 1.1% last week and up 9.2% year to date. The S&P 500 had an indifferent week, down 0.2%, up 16% year to date. And the NASDAQ, is the NASDAQ now starting to drift off? Has it peaked? It's still up an absolutely enormous 31% year to date, but it's down 1.2% last week. And on the Discord during the week, we were discussing how Apple has now reported negative revenue growth for 3 quarters in a row, but is priced like a growth company despite it having no revenue growth. Now, it has grown profits, but how long can it keep increasing profit margins to offset declining revenues? So it seems that Apple is completely mispriced. It's priced as a growth company when actually it's not. And Apple is the largest stock in the index. If Apple starts to fall, then the NASDAQ will also fall. This is the Hang Seng. Bad numbers out of China this week, down 2.2% on the week, down 3.4% on the year. Topics had a good week, up 1.3%, up 22% year to date. Bitcoin had a good week, up 1.3%, up 78% year to date. Sterling, indifferent, down 0.2%, still up 5.1% year to date. The euro down 0.3%, up 2.7% year to date. And the dollar index rose 0.5%, though down 1% year to date. VIX fell, down 7.3%, back down to 15.9. But market volatility remains subdued. A few charts relating to equities. Well, we are still in greed, despite the NASDAQ falling 1.2% this week. And after most companies have reported Q2 earnings, margins bounced back towards their highs. And we'd previously been predicting that couldn't happen. But margins in the US have been supported by good US fiscal spending, unsustainable US fiscal spending, I would say. And this is VIX. Well, VIX has been rising with the seasonal pattern, although it fell this week. But be warned, volatility now starts to rise into the danger months of September and October. And the top 7 stocks in the US are now worth more than the entire stock markets of France, China, the UK, and Japan combined. And onto commodities and energy commodities. Well, Brent had a pretty flat week, up 0.2%. WTI was down 0.4%. Now, if we turn to data specific to the oil market, well, last week we had a huge draw in the US. This week we had a build. So excluding the SPR, we had a build of 7.1, including the SPR, 8.1, which suggests the SPR actually bought oil to increase its storage. Now, the big news was a huge leap in US crude production as calculated by the EIA. So that leapt to 12.6 million barrels a day, a new high for the year, a big new high for the year, and up 400,000 barrels on the week. And that's despite the rig count falling 96 this year. So what's going on? Well, the EIA have upgraded their forecast for US oil production due to rising well productivity. And the dark line is their forecast as of July. The light blue line is their forecast as of August. Now, on the Discord during the week, Simon W. was pointing out that we're making a lot of assumptions about US oil production based on declining rig count. But actually, the whole shale revolution has been one of technological advancement. We are currently not recovering very much of the oil in the shale oil fields. If we improve the technology so we can recover more of it, then you could see much better oil production in the US, and that appears to be happening. Don't underestimate the capacity of the US to improve the technology. That's what they've done so far. Now, in Europe, we had a big rise in European natural gas prices, still down 50% on the year, but the market is nervous. The proposed strikes in Australia sent gas prices up 30%. And in the UK, they're up 24%. And those strikes are far from certain, but the market is nervous that any disruption to world LNG supplies would cause a return of very high gas prices in Europe. And that is despite storage levels being extraordinarily high for this time of year. In the US, gas prices rose a bit, up 7.8%, still down 37% on the year. Coal also rose, up 5%, down 63% on the year. And uranium rising back up a further 0.8%, up 16% on the year. So the whole energy complex actually doing okay. And on to industrial metals. Well, it was generally a bad week as the numbers out of China were disappointing. Aluminium was down 1.7%, down 7.4% on the year. Cobalt was flat. These numbers do not update very often, so down 36% on the year. Copper, Dr. Copper, is looking increasingly unwell, down 2.2% on the week, now down on the year. And that is despite China having very low copper and aluminium stocks. So if they were to restock, you'd expect copper and aluminium prices to rise. But the weakness of the Chinese economy suggests that is unlikely to happen anytime soon. Chromium, unchanged, down 10% on the year. Iron ore, drifting off again, down 4.6% on the week, down 12% on the year. And given the news out of Chinese property developers, could continue to drift off. Lithium, drifting, down 3.8%, down 50% on the year. Neodymium flat, down 42% on the year. Nickel falling, down 5.6%, down 33% for the year. Tin has had a good bounce recently, down 2.7%, up 10% on the year. Ferrovanadium flat, down 13% on the year. And zinc down 2.4%, down 18% on the year. Okay, add on to precious metals. So gold had a bad week, down 0.4%, up 5% on the year. But it's actually been pretty resilient in the face of rising interest rates. Silver, terrible week, down 3.8%, now down 4.9% on the year. Platinum also fell, now down 15% on the year. Rhodium going nowhere, down 2/3 on the year. Terrible. The big spike in rhodium prices has been pretty much unwound. Palladium had a bounce, but still down 28% on the year. And on to rates. Well, a thoroughly depressing week, frankly, for me. So UK bonds refusing to fall, and the yield curve is actually flattening. In the US, long-dated bond rates have risen sharply over the last month. And last night in the US, there was a badly received 30-year bond auction, which has led to a spike in long-dated bond yields. So the market is increasingly concerned about the long-term outlook for inflation. They're suddenly pricing in higher inflation. So the five-year forward has moved from just over 2.2% to 2.5% in the last month. The market needs to see the US economy slowing for bond yields to come down. Reminder, inflation looks very much under control and is coming down everywhere. So the rising bond yields are very much against my expectation. And we are in the longest bond market drawdown since records began in the early 70s. And their rolling 3-year returns are the worst ever in that period. And as a result of that, investors are much more positive on stocks than they are on bonds. And if we look at the rise in US 10-year yields, that seems to be quite well correlated, he says, with the US Economic Surprise Index, which has been doing well recently. So, to reiterate my earlier point, I think bond yields fall when the US economy starts to roll over. And given the imminent rise in US student debt payments, I'm expecting that to happen probably starting in September, but certainly in October. This is UK 2-year, which was kind of flat on the week, as was the 10-year, but the 30-year rose in line with the US. And these numbers exclude this morning's action, where bond markets at the long end sold off because of the poor US 30-year auction. So this is the US 10-year rising again, sadly. And in the Eurozone, yields have been rising. Italy, Greece, although absolute numbers remain subdued. So obviously, Richard is unfortunately ill today, but no change to my views. And concluding comments. Well, US inflation continues to decline and looks well under control currently, but wage growth remains too high for the Fed to be comfortable. Expect US rates to stay high until the economy slows enough to produce some slack in the labor market and a fall in wage growth. That means rates staying higher for longer. Given the fall in US inflation, the market and we are expecting the Fed to now pause and the Fed's hiking cycle to have peaked. In September, US student debt holders become liable for repayments once again, although they don't actually restart paying until October. And then that will reduce US consumer discretionary spending by between 9 and 15%. So that will weaken an already weakening economy. And in China, all the numbers out of China are poor. The Chinese economy is slowing and has entered deflation. And on to my activity. Well, I had a terrible week, and frankly, these numbers are for prices as of last night, and it's much worse this morning. So, as you all know, I have big positions in UK long-dated gilts, and currently it's not working. Despite inflation having peaked everywhere, long-term inflation expectations appear to be rising, leading to a sell-off in long-dated gilts. It seems that this trade won't start working until economies start slowing, and we expect that in the second half. In the meantime, I'm braced for further losses. I'm not looking very clever on the year, and it's not much fun, but you take the risk, and when it goes against you, you have to take the pain. No buys, no sells. So this week, let's talk about a couple of oil companies we have talked about previously. So this is Gulf Keystone Production. And I bought it back at 78p back in 2021, sold it at 265, close to the top, but you never get the top. And earlier this year, its share price collapsed following the closure of the Ceyhan pipeline from Iraqi Kurdistan through Turkey, after the Iraqi government won a court injunction, and the Court of International Arbitration ordered Turkey to pay Iraq 1.5 billion for allowing oil flows from Kurdistan without the permission of the Iraqi government. Now, since then, the pipeline has been closed. And we warned when we discussed this a few months ago that we expected the pipeline to remain shut for a long time and there to be difficult three-way negotiations. Now, what happened this week was that another oil company operating in Iraqi Kurdistan warned that it did not expect the pipeline to reopen anytime soon. And the reasons they gave were the ones we talked about months ago, i.e., Turkey does not really have much of an incentive to reopen the pipeline. What it wants to do is negotiate down that huge court fine. And until Turkey gets its way, the pipeline is likely to remain shut. And in the meantime, Kurdistan is running out of money. Its budget is being squeezed. And that means even when oil transport does resume, that the oil companies are going to find it difficult to get payment from the Kurdistan regional government. Reminder, Kurdistan regional government sells the oil, and then pays the oil companies with a lag. So I may have messed up my current bet on UK long-dated gilts, but I did at least get out of my oil companies at good prices. And this is Genel Energy, which also has operations in Iraqi Kurdistan and also has sold off. I would suggest that they are uninvestable until the situation is resolved. There's still too much hope in the price. Okay. Apologies for the lack of Richard today. Unfortunately, he has food poisoning and has retired to bed. Now, we are entering the summer season. I'm off for 3 weeks holiday, and there will be no portfolio matters over that period. We will return in early September. As soon as I get back, I will try to do an enormous data dump of macroeconomic data over the 3-week period before normal service resumes with regular weeklies. So in the meantime, have a good summer. I hope the markets treat you better than they're treating me. In the meantime, please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.